the U.S. says silver is now a critical mineral. China said, we agree with you, and we are going to limit exports to the point where every ounce that leaves China has to be permitted through Beijing. In other words, the government will say what goes, what doesn't go, and the free flow of silver, which China's a big exporter, a huge refiner, will put greater strain on the LBMA because they were one of the exchanges, the Shanghai Metals Exchange, that sent 20 or 30 million ounces to London at supposedly very high lease rates in order to plug that gaping hole with bubble gum. It obviously is leaking again. So we will see if China limits exports. And by the way, the U.S. calling it a critical mineral, all that metal that flowed back supposedly by tariffs, which it's not.
The silver market is rarely under such intense pressure. However, once more, it cannot be disregarded. The behavior of the spread between spot silver and the front month futures contract is one of the most obvious indicators that seasoned traders keep an eye on before significant delivery cycles. According to Andy Schectman, gold is behaving just like it ought to. Prices converge, the spread gets smaller, and the market remains stable as expiration draws near. But silver is completely breaking from the script. Days before longs had to decide whether to roll their contracts, close positions, or stand for physical delivery. The curve has returned to backwardation by approximately 26 cents instead of leveling out. Rarely does backwardation this close to expiration go unnoticed. It's a subtle but clear signal from the market that someone wants the metal immediately rather than a paper claim for later. Although it eased, the tightness that caused the sharp $3 backwardation rise never went away. Although leasing rates decreased, they never fully recovered. When roughly 50 million ounces arrived, London momentarily stabilized, but it was closer to repairing a crack than addressing the underlying pressure. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
What were we talking about?
Well, we were talking about the moves that the gold.
Oh, silver. So it's interesting. Right now, gold is in contango. Contango is a normal market function where the spot price is less than the futures price. Typically, when you're talking about any futures commodity price, you're paying for the storage, the interest expense, the cost of money. The further out you go, the higher the cost. So you go out 2 years and the spot price may be 4,500, 4,600, whatever. The further out you go, the higher the price should be. That's normal. On the 28th of this month, in 9 days, those who hold long contracts have to declare, they don't have to, but they typically do on that first day, declare if they are going to roll it, cash it, or stand for delivery, right? So as you get closer to the delivery date, that spread will narrow and narrow and narrow to it should get even with spot, right? What we see in silver is the opposite of that right now. It's a 26-cent backwardation. We're back in backwardation again, which we saw remedied briefly by 50 million ounces sent to London. And all of a sudden, within a few days, backwardation started to rear its head again. They basically plugged a gaping hole with bubble gum and baling wire. And a 26-cent backwardation in the spot price, futures price, this close to options futures expiration tells you that there's someone who wants silver right now, and there's tightness in the silver market. The leasing rates have come down, but last couple of weeks ago, they were as high as 100%, 200%, as we were $3 in backwardation. Speaking of extreme stress, now we're not there yet. The fact that we're almost at the declaration point and we're in a backwardation tells you that there are big people, and the December contract's a biggie because it's delivery for both gold and silver. The fact that the gold market is saying everything's okay, I guess, the silver market's saying not so much. There's not enough supply. There's more physical demand than there is bars to satisfy those contracts. I think it's going to get kind of interesting over the next 9-10 days. We'll see what happens, but I think it's going to be a huge delivery month. Yeah, so it was kind of like the U.S. says silver is now a critical mineral. China said, we agree with you, and we are going to limit exports to the point where every ounce that leaves China has to be permitted through Beijing. In other words, the government will say what goes, what doesn't go, and the free flow of silver, which China's a big exporter, a huge refiner, will put greater strain on the LBMA because they were one of the exchanges, the Shanghai Metals Exchange, that sent 20 or 30 million ounces to London at supposedly very high lease rates in order to plug that gaping hole with bubble gum. It obviously is leaking again. So we will see if China limits exports. And by the way, the U.S. calling it a critical mineral, all that metal that flowed back supposedly by tariffs, which it's not, they can just as easily limit or shut off exports out of the United States as well. The president can do it with the drop of a hat without congressional approval. And the fact that it has been labeled a critical mineral tells you it's now a matter of national security and of policy. So,
and of course, you know, we're going to have to go out as a country and buy a stockpile because we ran out of all of our stockpile in 2020.
Actually, the government has taken positions in 2 or 3 mining companies up in I think they're up in Vancouver in the Golden Triangle, or up in that area. You have now government stepping in the resource sector the same way they did with General Motors. It's a different thing, but whenever you put mix government with private enterprise, usually bad things happen. But nonetheless, it shows you that they are trying and taking very seriously the fact that it's about he or she who has the metals and the commodities wins. It's not just he who has the gold. It's obviously he who has the critical minerals. And one other thing, you look at China, not only do they produce the lion's share in the Eurasian continent of rare earths and critical minerals, but they're also probably they refine upwards ends of 95% of all of the world's critical minerals. We are lacking in so many ways, and looks like the government's now taking things seriously, including silver and platinum, not just the critical rare earths and the critical base metals that you would need to run a country efficiently. You can't be reliant on the rest of the world to provide that for you.
Schectman's argument stands out because he is merely following the arithmetic rather than making big assertions to get attention. Silver theoretically indicates toward the low $700 level if gold eventually reaches $5,000, and silver is emerging from the earth at about 7 ounces for 1 ounce of gold. The long-term gold to silver ratio of roughly 42 to 1 puts silver in the hundreds of dollars, even if you use considerably higher gold targets. His point is simple: after decades of pressure and deception, markets frequently move much beyond what appears acceptable. According to Schectman, the paper silver market is the source of the largest distortion. For every actual ounce in existence, there are still hundreds of paper claims. This gives the impression of abundance and keeps prices artificially low, which just so happens to help governments and businesses that depend on inexpensive silver for electronics, defense systems, solar energy, and energy infrastructure. It is not coincidental that silver has now been formally designated as a key mineral by both China and the United States. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
I think that we need to see 100 before we see 1,076.
Well, let's do the math. If the geologic ratio right now is 7 to 1, let's put gold at 5,000, divide it by 714. So if it's at it's got it, you're talking.
What if we go to records?
Rickard says 24,000. That's the number he says gold will go to when revalued based upon, I think, the M2 money supply and the gold that we supposedly own. Even if you divided that by 42, which is the average ratio between the two for the last 100 years, that's only 571. So yeah, you'd have to see a 12 to 1 ratio at 24,000. It's lofty, but I'll say this. The one thing absolute that I've learned, and there are very few absolutes in the world, especially in finance, there's probabilities, but absolutes are rare. The one absolute I have learned is that markets go higher than anyone ever thinks possible to the upside, and bear markets fall further to the downside than anyone thinks possible. When I started in 1989, 1990, the Dow Jones was around 2,100, and the Nikkei was around 40,000. The Nikkei made it all the way down to about 12,000 and just recently got back to where it was for a minute. I don't know what it's at now. I think it's under that number, but it took a generation to get there. And at the same time, the Dow's gone from 2,000 to over 40. So, who would have ever thunk it? Maybe, who knows? In a world where gold and silver have been suppressed to support the illusion of Western market supremacy, where are you going? And that is what I would say the silver to gold ratio trade is. It's almost a sure thing. It's the best calculated speculation I've ever seen. You buy silver at 88 to 1, knowing it's coming out of the ground at 7 to 1 geologically, 16 to 1 geologically for 5,000 years. Now it's depleting, fallen to 7 to 1. It's disappearing, manipulated by the West to create this illusion of worthless silver to, I believe, support the military industrial complex's need for silver. No one wants silver. Don't look here. Not about price. It's about everyone realizing its true value. U.S. government just did call it a critical mineral. China did too. The point of it is that it's way out of whack because the West has suppressed the paper price where 400 paper contracts to every 1 ounce. That's going to end. But even that one great play you can fumble, you can trip, you can get intercepted. The problem with that ultimately could be, well, maybe gold, like the gold buffalo, you can't find it. I still think it's probably the best trade. It's a trade of a generation, but it's not fail safe. And the worst thing is you end up with a bunch of silver, which in my mind is a substitute for gold. Right now at 88 ounces, historically 16 should be a lot less, geologically 7-1. So yes, but I'm never really a fan about going all in. Maybe put a little bit in gold and kind of dip your toe into it.
80-20 maybe.
Yeah, 70-30, 80-20.
70-30, 80-20. All right, let's get a couple more.
2 more, 3 more.
Yeah. All right, let's go. Yeah, it's
certainly every
time
possible. We've seen the price fall to places where it shouldn't be. The reaction of the market is nah, and premiums go parabolically higher than the fall of the spot. Spot would fall by 10, premiums go up 12.
Well, that's what I was going to say. In terms of if you're looking to wait,
there's too much physical demand. It'll just be gobbled up just like that.
That's what I was going to say. I mean, just like we saw back in March of 23, spot was only 18, 19, $20 around that time frame, but premiums on Eagles then jumped to $20, $18 over spot.
The big banks that suppress the paper price have to be saying, we get on the wrong side of this and we get a bunch of people saying we want delivery. It's an existential threat. I don't think you'll see it. And if you will, it will be a blip. Back up the truck if you do, but I would say no.
Well, look, I mean, we just saw in that bad downturn several weeks back, we saw it go from 53 and change down to 46. And just like that, we were back up to 54.
Yep.
I mean, again, it's the things that you were saying back in the day that it was, silver was typically making that 20 cents, 40 cents moves. Then we started seeing the one. Now we're seeing $2 moves as much more commonplace.
But, when silver's $20, a $2 move's 10%.
Right.
When it's $50, a $2 move is 4%.
That's right.
So the higher you go, these moves are freaking people out dollar-wise. But think of the percentage. It's the same thing when people say the Dow Jones is down 400 points. Big deal. That's 1%.
It's nothing.
Right?
So it's absolutely
think
nothing.
Of the bigger the number, the scarier the percentage in dollar terms. But in reality, it shouldn't scare you because it's the same percentage.
Oh, I like this question. Mold and I kind of on the heels of the other question. If someone goes all in on silver, hoping to trade for gold later when the ratio normalizes or shrinks, is there a risk?
What?
Is there a risk, Andy, that there won't be gold available for them to swap?
That's what I just said. That is the risk. That's the fumble or the interception. You try to trade back and gold isn't plentiful like the gold buffalo. That is the only risk I see. Could happen, could it? Yeah. I mean, after what we've seen in the last several years under the Biden administration and the pandemic, can we really say that the crazy can't happen?
Finally, Schectman's lesson is about realizing the distinction between silver's actual physical value and its paper price. He wants people to understand that silver is a metal that is closely related to energy, defense, technology, and economic stability, rather than just being another commodity. A significant long-term opportunity is being generated by the enormous disparity between the amount of silver that truly exists, how quickly it is being consumed, and the artificially low price brought about by paper contracts. He highlights that silver presents one of the most asymmetric settings in contemporary financial history. You risk little, but the potential reward is enormous even though no investment is guaranteed. There's a reason why the market is acting strangely. Physical inventory is getting tighter, government agencies label silver as important, and premiums increase each time a spot decreases. These signals are not minor ones. They serve as cautions. Investors are being urged by Schectman to consider the wider picture. Long-term investors shouldn't be alarmed by volatility because price fluctuations are common and percentages are more significant than monetary amounts. Understanding when a market is severely mispriced is what really counts, and he believes that silver is just that. The final section asks viewers to realize that this isn't just hype. Geology, industrial demand, supply constraints, geopolitical unrest, and decades of price repression are all coming together at once. The disconnect won't endure forever, and when it does, it has the potential to completely transform a generation of investors. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.